Hey guys, it's Hal, and I wanted to come here today to share some information with you. Recently, Keller Williams has taken a very bold stand to try to address some of the issues that are occurring out there in the world as it relates to racial tensions and issues of discrimination. And in an open letter back in June, many of you remember that Gary Keller had taken the stand that said, the truth is this, that racial injustice still persists. And in order to change that, it's really critical to not only say something about it, but actually do something about it. The final financing issue that I want to talk about today is one that may not even be as apparent. And it really has to do with failure to truly understand and accurately interpret to our sellers and our buyers the low down payment financing options. Typically, what we're talking about is the FHA products. As a fiduciary, the R in old car, if you remember that acronym of obedience, loyalty, disclosure, right? Accounting, reasonable care. The R in old car is reasonable care. Are we doing everything that a professional would be expected to do to provide the finest quality of care to our clients? And one of the areas that is subtle, and yet it can be problematic, is failure to truly understand these FHA products. Now, the Fair Housing Administration came about in the 1930s after the bust of the Great Depression of the 1920s, when people had jobs again and they had credit, but they had lost so much of the home equity in their home. The value of their home had been totally lost in the bust of the Depression. And what we know is that for most Americans, our home equity is our largest asset. It is our absolutely largest asset. And so what the FHA decided was, even if you don't have a whole lot of down payment money, if you qualify, we are going to insure the lender, right? Because the lender has more skin in the game than the buyer in a low down payment option. And so the FHA was designed to offer an insurance policy to the lender so that they would be willing to lend to buyers who were credit worthy. They just didn't have a lot of cash. Now, one of the things that's happened throughout history, and I think we all know that through the years with segregation, housing segregation, we learned about redlining, we learned about all those things in real estate school. And guys, you remember that earlier video today, that sometimes the subtlety of how we steer people into some neighborhoods versus other neighborhoods continues to make it difficult for people of color to get into certain areas, and typically the high-priced, the high affluence neighborhoods, right? And one of the outcomes of that has been, through the years, there has just been an enormous wealth gap between white families and Black families and Hispanic families. And what the Brookings Institute tells us is that when you study the actual impact and the wealth gap, what we find is that white families have a net worth that is 17 times that of Black families, right? And so many times when our clients are using FHA products, it's often possible for us as agents to look at a larger down payment as a sign of being more motivated, right? Of taking the risk out of this because there's more skin in the game. And so we're going to be inclined to accept an offer with conventional financing because there's more down payment. They're more motivated. They've put more money at risk, if you will, in case the buyer breached the contract. And yet, many times, what happens is it's not an issue of motivation at all. It's just an issue that some folks have more money than others. And when we interpret the inability to have down payment money as an issue of motivation and not an issue of family wealth, we can steer sellers to make decisions that are biased against families of color, because these are the products that frequently are used when folks don't have down payment money. Right. And so it's something that we have to be really, really careful about, because the risk in the FHA product, the risk that the government is actually insuring, is the risk to the lender. The risk is not necessarily to the seller. Properly qualified, what the research tells us is that FHA loans do not fall out any more than homes that are financed by conventional financing. When properly qualified, the risk to the seller is exactly the same. And so we have to be able to help our sellers understand that. We ourselves have to truly understand that and let people know that when they're comparing apples to apples, an FHA option versus a conventional option, that they have to be seen as equivalent. Because if we choose the financing of the conventional over the financing of the FHA because of the security of the down payment, we could potentially be allowing our biases to contribute to decisions that are in fact discriminatory. Now, what we also know is that the FHA guidelines are even more broad than conventional financing and allow for more buyers to participate. And so in many ways, FHA financing creates a bigger pool, which is actually an advantage to a seller, because what we know about market dynamics is that more people who are involved give us a bigger base and more competition. More competition creates a better price in a market economy, right? And so we have to just really be clear that we understand this. Now let's be real. What we do know is that FHA products do require that the property meets a higher property condition standard. Because the lender has more at risk, the FHA appraiser will look much more closely at how does the property stack up. Is it a condition which is really worthy of being insured, right? And so best practice in this area, guys, would be if we're actually concerned that the property may not pass muster, that there are going to be things that would be problematic for an FHA loan, then we've got to make sure that sellers keep the focus on the property itself and the property issues and not the buyer and the financing.